Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday, October 30th. Hope you guys have a great Halloween weekend up ahead here and be safe. Let's jump into it. We've got a lot to go over today. We've got a lot of economic news releases. So today we'll start off with the personal income for the month of September. So previous reporting, we had a 0.3% increase back in August, and forecast was supposed to be 0.2%, and it came up a little shorter than the forecast. It was at 0.1%. Also, consumer spending, it dropped a bit too. I mean, it's up for the month, but it's lower than our expectations. So we had 0.4 back in August, and forecast was 0.2% for September, and it came at 0.1 as well. Core inflation, this is the PCE. This is the Fed's favorite gauge for inflation numbers, and this is when you strip out the food and energy, we get the core inflation. So we had a 0.1% for the month of August, and it was supposed to jump up to 0.2%, and it came in at 0.1%. So basically that leaves us year over year at 1.3% so far. Still very low compared to where the Fed would like it. The Fed would like to have it about 2%. And they did make a little note of that in their last Fed meeting here that got released here on Wednesday. One of the things that they didn't see was that they'd like to see the inflation up closer to 2%, and it didn't move. So this is something we'll probably want to wait and watch until we see until the next Fed meeting in December to see if this goes up at all, because that could play a part into their final decision making as to whether they raise rates in December or not. As we stated yesterday, the Fed it had a very hawkish tone to their plan. They really want to raise rates, but with the circumstances around, it doesn't look like with these numbers, with earnings reports coming in bad, not too great information data we're seeing, especially as yesterday we saw the GDP coming at 1.5%. Not looking too good, like where we should be to be raising rates and forcing ourselves back into a recession again. So that would be kind of counterproductive, my opinion, and I think a lot of investors probably think the same thing. To move on here, we got the employment cost index. Now, this is something to keep an eye on because this, as you see back in the previous report, it was at 0.2%, and forecast for Q3 was 0.7%, and it went up to 0.6%. That's pretty substantial because that means the cost for having an employee went up a bit at 0.6%, and that could be inflationary numbers in that in itself on there. And a lot of that probably is going to be due to the Obamacare and the healthcare costs out there. Not to be bashing Obamacare, but it's face facts. Corporations' benefits have gone up quite a bit as a result of it. Chicago PMI, October. So back in September. Last month we had a 48.7. This is a contraction. Anything below 50 is considered contraction, and we jumped up to 56.2. So manufacturing in Chicago region improved in the month of October, so that's good news right there as well. And last but not least, we got the consumer sentiment this month, and the final reading came in at 90 after having a previous reading at 87.2. But it did come up a little shorter than what we expected, but it did come up higher. So kind of a mixed bag of news here. Personal income and spending, of course, lower than we like it. Core inflation still low. Employment costs went up, so that could help drive inflation, which is obviously we're kind of looking for higher inflation. Chicago PMI improving and consumer sentiment improving as well. Now, next week, we're going to see a lot more of the jobs numbers, so be prepared for some volatility there. We'll get Friday. The Bureau of Labor Statistics will be releasing their job data. We got the weekly jobless claims, and Wednesday will be the ADT numbers will be coming out. So be prepared for some volatility in those signs as well. Stock market's up a little bit today as a result. One of the things that came in to note is investors were kind of hoping that the Bank of Japan would create more stimulus, and they had their meeting and basically left rates unchanged. So nothing out of the ordinary left Japan. So they're probably on the Asian markets were a little disappointed as a result of a lack of any stimulus as they were hoping. Bond market, we got improvement. We're back just below the 200-day moving average. We'll have to wait and see if that becomes a strong floor, a ceiling again for us, or if we can break above that. If we can break above that, that could help us for next week. As we broke below that, as you may recall, about a month or so ago when we were below it, it was a strong, tough ceiling, and it took forever for us to get through. We tested many times, it kept bouncing down, tested many times, kept bouncing down, and finally broke through it over the past month. But we'll have to wait and see if it becomes. But we're up about 19 basis points from where we left off yesterday. So from where we left off yesterday, we do have an improvement in our pricing today. But that's going to be an important thing to watch for, is if we could break above that 200-day moving average. All right, folks, have a wonderful weekend here. Be safe, and thanks so much for watching. Sorry if it's been long, but we had a lot to go over today. Have a great day. Bye-bye.